All right, welcome to The Explainer. Today, we are going to pull back the curtain on something that can seem a little complicated, but is actually super straightforward: term life insurance. So let's just dive right in and break it down.
I mean, just think about it for a second. You've got family, maybe a house, big plans for the future. You're the engine that keeps it all running. But what happens if that engine just stops? That's really the core question that life insurance is meant to solve.
And honestly, the simplest answer to that question is term life insurance. I absolutely love this way of thinking about it. You're renting financial protection. It's like you get this giant financial safety net, but only for the specific time you need it most. When the mortgage is high or the kids are still at home. So what is it really? Well, at its heart, it's a very simple promise. You pay a regular amount, which is called a premium, and in exchange for that, an insurance company promises to pay out a big chunk of cash if you pass away during the time the contract is active. And that period of time? That's the term. Simple as that.
Now, you are in the driver's seat when it comes to how long that protection lasts. You'll usually see terms of 10, 20, or even 30 years. The real trick is to match the length of the policy to your biggest financial responsibility. So, got a 30-year mortgage? A 30-year term policy makes a whole lot of sense.
Okay, to really wrap our heads around this, we've got to know who's who in the whole setup. There are really two main roles you need to understand, and knowing the difference is, well, it's key.
So on one hand, you have the policyholder. Think of them as the owner. They're paying the bills, they're making the decisions. On the other hand, you have the life insured. That's the person whose life is actually being covered. Now, a lot of the time, these are the same person, but, and this is where it gets really flexible, they don't have to be.
Let's make this real with a quick example. Here's Sandra. She wants to make sure her son, Tristan, is taken care of, so she buys a policy on her own life. In this case, she's the one paying for it, the policyholder, and she's also the one being covered, the life insured. This is probably the setup you're most familiar with. But now let's flip the script. Same person, Sandra, but a totally different deal. This time, her company buys the policy. The company is the policyholder. They own it. They pay for it. Sandra is still the life insured, but if she passes away, the company gets the payout. Why? To help them stay afloat after losing a really important employee. It just goes to show how flexible these things can be.
So moving on from that, the next big question you're going to face is, should this policy cover just one person, or can it cover two people at the same time?
You've basically got three flavors to choose from. Single life is exactly what it sounds like. It covers one person. Then you've got two kinds of joint policies. A first-to-die policy covers two people but pays out when the first person passes. And a last-to-die policy, well, you guessed it, it waits until the second person has passed away before paying anything.
Okay, that first-to-die name sounds a little intense, right? But it has a perfect use case, covering a shared debt. Imagine Sue and Cindy. They just bought a house together. If something happened to one of them, the other would be stuck with that whole mortgage payment. A joint first-to-die policy solves that problem instantly. The survivor gets the money, pays off the house, and a huge financial weight is lifted. It's a brilliant tool for couples.
All right, so we figured out who is covered. But what about the actual payout, the death benefit? Most people just assume it's one fixed amount that never changes. But nope, you actually have some really interesting options here to shape how it all works.
And you can see it right here. You can choose a payout that stays completely flat, one that goes down over time, or even one that goes up. And each one of these is built for a very specific kind of need.
So first up is level term. This is by far the most common choice. It's super straightforward. If you buy a $500,000 policy, the payout is $500,000, whether it's year 1 or year 20. It's simple, it's predictable, and that gives a lot of people peace of mind.
Then you've got decreasing term. Now this one is tailor-made to cover a specific debt that you're paying off, like a mortgage. As your loan gets smaller and smaller, your insurance coverage gets smaller to match it. And the huge plus here, the premiums are usually cheaper than a level policy.
And finally, we have increasing term. This is a really powerful one because it helps your coverage grow right alongside you. So why would you want the payout to go up? Well, two big reasons: to fight off inflation over the long haul, or to match your family's needs as your income hopefully grows over the years. It's all about future-proofing.
All right, here we go. This brings us to the question that everybody, and I mean everybody, wants to know. What does this stuff actually cost? What are we talking about in terms of premiums?
So what's the bottom line? Well, the price you pay, your premium, it's all based on risk. An insurance company is going to look at things like your health, your lifestyle, even your gender. But there is one single factor that stands head and shoulders above all the rest.
And wow, this graph tells the whole story, doesn't it? The single biggest thing that determines what you will pay is your age when you buy the policy. Just look at that curve. It's kind of flat when you're young, but man, does it shoot up as you get older.
Let's put some real numbers to that graph to make it sink in. For the exact same $100,000 policy, a 30-year-old might pay around $134 a year. But if you wait until you're 60 to buy that same coverage, the price jumps to over $600 a year. That is more than 4 times as expensive. The message could not be clearer. The younger you are when you buy it, the cheaper it is. Period.
So, let's just quickly tie all of this together. 1. Term life is temporary, rented protection. 2. You can cover just yourself or you and a partner. 3. You can shape the payout to be level, decreasing, or even increasing. And 4. The big one. Your age when you buy is the #1 thing that drives the cost.
So there you have it. We've gone through the what, the who, and the how of term life insurance. You see? It's a really powerful but also a surprisingly simple tool. So the only question left is the one you have to answer for yourself. What and who in your life needs protecting?